If you've been told just to draw a line across the tops and bottoms of your chart, buy when price hits support and sell when it hits resistance, I have some bad news for you. You're being set up to fail. How many times have you entered a perfect support trade only to watch the market instantly blow right through your level, stop you out, and then move exactly where you thought it would go? It feels rigged because honestly it kind of is. Today we're unlocking why traditional support and resistance is a trap, how the market actually uses those levels to build liquidity, and how you can stop being the liquidity. Let's get into it. First, let's talk about what traditional retail trading teaches you. Textbook technical analysis says well, support is a floor where buyers step in and resistance is a ceiling where sellers take control. So here's NQ. So if we take what I just talked about and apply it to the charts, this is how you've all been taught to enter your trades based off support and resistance. First, I'll draw out our support line, or our support, okay? You can make it even a little tighter if you want, it's all preference, but you can easily tell there's a clear line of support here because we come down to this exact level once, twice, 3, 4 times. So say the price pushed up and it pushed back into this zone, right? You would have been entering somewhere up in here with a stop loss below here, okay? And you can see price shoots down and then rallies upwards to the bigger move, like that. So that's how you've been taught to enter off support. Let's go find a resistance example. Okay. The only thing I want to say now is you want to use support and resistance in confluence with trend. And I know I already talked about trend a little bit before, but you can tell that NQ here is an obvious uptrend. So you'd only want to be playing support here, right? We're looking for levels of support. Here is, let's go find a resistance example. Okay, this is a fine one. Okay, you can see this this little line of resistance right here. So, okay, so you can see there's some resistance at these levels here on NQ 24,324.25. Okay, like that. So price comes up again, rejects. So you would have probably entered short somewhere in here. And you can see obviously there was no sweep is what we're going to call it. And that's what I'm going to kind of venture into in this video is what a sweep in liquidity is, right? So what's actually happening at these levels, especially this is a great example up here, this other one, of a sweep. So this is where engineered and bank liquidities are. And what happens is banks need to fill millions and millions and millions of dollars worth of orders, and what they have to do is they have to push below stop losses on other banks, maybe even other retail traders, things like that. So what happens is they come down to this area right here, and this is them filling their orders. Nope, that's not the brush. They come down to this area right here, and that's how they fill their orders, and then they push price up. So that's what a sweep is. That's what you want to use your support and resistance in confluence with. This other example that I just showed you is a good example of resistance and how this trade wouldn't have worked out specifically because of this concept. There was no sweep. They didn't push above and fill orders. All they did was come down here, actually, to this support right here, and you can see the sweep is right here, and that's where price pushed up. So there always has to be a sweep of liquidity, which is what it's called, a sweep of liquidity with your support and resistance. You always want to use support and resistance with your trend. You don't want to fight trend. Trend is your friend. I said that in the video prior. So let's go find another good example of this working out. Okay, here's another good one. So this is kind of, obviously this is days of price, but here's another good one. So you can see that there is a clear line of support here, okay? Clear line of support. You would have maybe entered, you saw price pushed up off this level, come back down to this level, right? Pushed up, come back down. Maybe you entered here or maybe even here, whatever you did, right? You can see that the real move would have happened. Oh, well, I guess that's a terrible example, isn't it? This is a good resistance example, my bad. I wasn't looking at the trend, see? Even I tend to mess things up, but you gotta look at the trend. Here's your resistance here, okay? Come up, reject. You had entered here, this is where you want to be entering. This is the safest place. I guess is what I'm trying to say is when the liquidity sweep happens and it's obvious to the naked eye, that's when you should be entering the trades, not when there's no sweep in liquidity. You got to think how the market actually moves. It moves off people placing and or buying and selling of orders. So there has to be someone buying when they're selling. This is how they get you to sell, is by hitting the stop loss up here, and then they're going to take your orders and shoot them down. So I guess that's all I really have to say about support and resistance and how it plays into liquidity. Now this is kind of a stepping stone to my model, and especially if you watch the trade recap video of today, June 4th, you would see that I entered, or well, one of my confluences in placing that trade was a sweep in liquidity, specifically a London low, which obviously is a more complex example, but you want to always have a sweep. It's like the stepping stone to every trade, having a sweep in liquidity. That way you can get on the flow of the banker's orders, not trying to fight the bank. You don't want to fight the bank. We can't win that battle. What you can do is ride on their flow, right? So other than that, that's really all I have for support and resistance today. I just want to show you one more example, and then I'll probably end the video of just me drawing out a sweep in liquidity. So we'll go, I keep doing that. There we go. So here's a sweep in liquidity. Maybe price puts in that high, right? And this is where you want to have your sweep at. That's a terrible straight line, but whatever. Price is going to come up, take their orders, fill orders, and then shoot price down. And it works the exact same for buying. So say price comes down, puts in this low here, comes back up like this, and then shoots down, and then price should. This is going to be your sweep in liquidity. And obviously this goes into other concepts like breaker blocks, changes in state deliveries, breaker structures, things like that. That's all stuff I'll get into eventually, but you have to learn liquidity first. If you can master this concept and noticing where engineered liquidity is, where bank liquidity is, if you can notice those concepts, you can basically predict where price is going to go, because you can basically predict where the banks are targeting to either sell or buy orders. So if you can really master liquidity, you can master trading and become a very successful trader. But other than that, that's all I have for this video, and I will see you guys in the next one.